Hey investor friends, I'm Michelle Markey, and today I'm going to talk about what stock market returns you can expect if you're investing now as of June 2022, because it probably feels like our portfolios are gushing red and it feels like gloom and doom, even though it's so nice and sunny out. But there are many factors that are working against our portfolios, and it's important for us to set realistic expectations so we don't run into disappointments when things come to pass. And some of the factors working against our portfolios growing right now include how inflation is at 40-year new highs of 8.6% consumer price index inflation as of the end of May 2022, as well as how the overall stock market is starting to be in a bear market, with the S&P 500 now down 21% from its all-time highs of 4,800 in early January 2022. And I think it just closed at around 37.90 the last I checked. So that's still entering into a bear market, and we might be in the early innings of a bear market. And then a recession may also be underway, as the US GDP contracted by 1.4% as of the first quarter 2022. And then also mortgage rates are soaring. When I last checked a couple of days ago, they look like they hit 6.73% if you have good credit and you're getting a 30-year fixed mortgage. And then to add insult to injury, on June 15, the Fed decided to raise the Fed funds rate by 75 basis points, which is 0.75%, to combat the raging inflation that we're seeing. So across all of these things, it's totally understandable if we're feeling a little bit down on our assets, but I have hope and some suggestions for what we can do. So never fear, because we can still get some decent returns over time. And it's important to not focus on the negative, but to focus on what you can personally do to not only preserve your wealth, but hopefully grow it over time. And hopefully when some of the negative returns are over with, we can go back to the stock market generating decent returns the longer that we hold our assets. So if that sounds good to you, I hope you'll like and subscribe to my video and YouTube channel, because I believe in us as investors and I believe we'll get through all this. So thanks. If any of us were lucky to have invested in US stocks over the past decade, a rising tide of a 13-year bull market generally lifted all boats, as the S&P 500 delivered annualized returns of 16%, which is double the stock market's average historical rate of return. So as impressive as that was, maybe it led to some of us believing that it was normal to get something like 24% annual returns like we would have averaged if we had been invested since the beginning of 2019, where the S&P 500 was at 2,500 and it almost doubled to 4,800, and that effectively gave us an average of 24% over 3 years. So that's pretty amazing. But it seems, unfortunately, that the good days may be over, because a lot of Wall Street experts are projecting that future returns will not look as rosy as they did over the last few years. So we have to have a sober approach to what we're dealing with here, because it was starting to concern me when I would see indicators of the overall stock market's valuation reaching highs that were getting pretty close to what they were in the dot-com bubble, such as the Shiller cyclically adjusted price to earnings ratio, or also known as Shiller PE. And on November 8, 2021, that had reached 40, and it hadn't reached that for a long while, since the dot-com bubble when it was at 44 back then. So it was starting to concern me back then, and that would have meant that forward stock market returns would have been as low as 2.5% at, if you divide 1 over 40. And then less than 2 months after an S&P of 4,700 gave a Shiller PE of 40, in early January 2022, the S&P 500 went up by another 100 points to 4,800, and that gave a Shiller PE of 37. And that's probably reflecting how some more inflation has creeped into the equation, and that led to a suggested rate of return of 2.7%. So it was slightly better than the 2.5% in early November 2021, but still not the best. And then if we fast forward to today in mid-June 2022, we're looking at a Shiller PE of 29.64, which is giving a suggested rate of return of 3.4%, with the S&P 500 now at 37.90. But if we also look at what its recent 52-week low was, where it reached down as low as about 3,700, that meant that we had a S&P 500 declining by about 23%. And eerily enough, if we were expecting the S&P 500 to give the stock market's average rate of return of about 7%, we would need the Shiller PE to go down to 14.3. So we'd have to basically cut the S&P 500 and Shiller PE in half in order to reach those levels again, or have essentially a decline in the S&P 500 by another 1,830 points to go down to an S&P 500 figure of 1,960, which coincidentally would be pretty close to what legendary investor Jeremy Grantham is predicting that we'll go to. So overall, we might have another 37% of downward trajectory to go to get to an overall decline in the S&P 500 of 60%, just to get to a point where the Shiller PE would be at an average amount, so that if we expected average stock market rates of return, we would need that much to be declined in order for us to even get a half decent return in the future again. As awful as it feels like to be losing money with the stock market declining for 6 months now, we could be in the early innings of a bear market, like I said, with a lot more hurt to come. And if we extrapolate from recent trends, the S&P 500 reached a 52-week low at 3705 on June 14, shedding about 1,100 points from its January high. And so if we divide that math out by 6 months, that works out to a loss of about 183 points per month. And so if we expect to get back to average stock market returns of about 6.7 to 7% per year, that would be a Shiller P of about 14 to 15, and it would take losing another 1,830 points to get to a range of the S&P being between 1,900 to 2,000 just to get back to average rates of return. So if you work that out, we could be still another 10 months away at the current rate of loss until we might be at a point where the S&P 500 is giving these average yield. So that would put us to early spring or April 2023 before we might be able to get these average rates of return. So perhaps you might want to consider staying in cash or investing your money elsewhere if you don't want to sustain negative returns until maybe 10 months from now. And while stocks initially jumped after Jerome Powell said that the Fed would stay tough inflation, that's probably just some algos doing their trading, but it's actually probably not sustainable for the market to go up. And of course, I could be totally wrong. The market could go up or down, and I don't have any idea where it will exactly go. But the likelihood that it will go up more doesn't seem likely, because the Fed is now entering into quantitative tightening, which means that they're not buying as many bonds as they did during the last couple of years. And also they're raising the Fed funds rate, which dictates interest rates for everything between your mortgage and credit card rates and all other kinds of loans that you might think of getting. So the chances are of easy money policies being there to rescue stocks is not likely anymore. So I think that there will be more down than up, but we might see some dead cat bounces in the meantime. And so some of the ideas that I have of what you could potentially do is, if you just want to invest consistently, sometimes that ends up being the best way to just dollar cost average your way into the markets, no matter if it's going up or down. And over the long term, some studies have shown that that's the best way to go, is just to consistently invest in the market. If you don't want to do too much work and you're okay with being passively invested in index funds and ETFs, that might be one way to go, so that you never have to worry about trying to figure out what the stock market bottom might be. But you may be paying a little bit higher in stock market prices in the meantime, and the stock market could take a while to recover, either a few years or decades to recover, who knows. And then you could also wait until the stock market has declined by at least 50%. So going from the S&P 500 of 4,800 down to 2,400, and then starting to invest your cash more aggressively at that point in time, whether that's 10 months from now or some other point in time when the stock market is closer to its average historical PE ratios. And then also you could decide to research and look into individual companies where you believe in them and you're voting with your money because you want to see that company continue to churn out its products and services that you believe in, and that you want that company to have good returns in the future. So that might be another way to go, and that would allow you to not really pay as much attention to whatever the rest of the market is doing, because you're focusing more narrowly on being a concentrated investor in a few company stocks. And that's actually the way way that I'd rather go, is that even though I'm sort of paying attention to the overall stock market, for me, it's just to give some slight clues as to what some individual companies might be doing. And even though a lot of experts say that value will perform better than growth for the foreseeable future, you don't necessarily have to read too much into that, because I think it depends on a case-by-case basis what each stock will do. And so those are some ways that you could go. And if you also consider your opportunity cost of not investing for the next 10 months, let's say, you could avoid losing another 50% if the stock market halves by going from 3,800 to 1,900. So in a way, you're kind of saving 40% because there's inflation of about 9%. So you're losing that, but at least you're not going from having $10,000 down to $5,000. And maybe instead of that, you could potentially invest in a Series I bond where after a year, you could still be getting a net return of about 7.2%, like I talked about in one of my videos. And so instead of ending up with $5,000 with the stock market halving, you could end up with $10,000 and $720 in net interest that you earned on a bond of having it for only a year and then redeeming it. So that might be one way to go. And then you can plunk your $10,720 into the stock market if and when it's available at a reasonable price to give you decent future returns again. And let's not forget that US stocks and bonds are not the only asset game in town, where we have the potential to invest all over the world. So we should definitely keep an eye out for some of those opportunities, as some big name firms offered up their forecast for what some intermediate term returns might be like. And they offered these forecasts when things were most optimistic in the stock market in late 2021. So this is when things were good. And I imagine that some of their forecasts might even be downgraded even more now, considering that the stock market has been declining for a while now. So all of this is even with a tinge of optimism built into them, and they're still kind of forecasting lower than average rates of return for a lot of kinds of assets. So definitely keep that in mind. But some of these big name firms include the likes of BlackRock, GMO, JP Morgan, Morningstar, Research Affiliates, and Vanguard, who projected an intermediate term rate of return over the next 7 to 10 to 15 years, giving assets a return of a nominal rate, which means that it's the rate that you get before inflation is accounted for. And if you incorporate inflation, I average from a couple of them to give a rate of about 2.4% over 10 years. So if you factor that in, the rates of real return will actually be lower, but the average nominal returns for the different asset classes would be things like 2.1% for US equities and 4.6% for developed markets equities, which would be places like Europe or in Australia, and also for emerging markets equities, that's 6.7%, and that would be in places like in Asia. And then for US bonds, it's giving 1.4% average nominal return. So across all of these, the only one that's giving stock market average rates of returns could be in emerging markets. And also a lot of these firms seem to be attributing higher returns to maybe value stocks. So definitely keep that in mind if you want to get half decent returns somewhere in the world. And a few final tips to help you get prepared for what could be coming is I created this recession checklist video that I encourage you to check out to see what kinds of things you might be able to do to improve your position and get ready for taking advantage of opportunities that might come your way. Because if you do things like have an emergency fund and stockpile some cash, then you're in a great position to be able to invest in stocks and other kinds of assets when they've been marked down, and then it's like getting something 50% off at the grocery store. You're happy because you were able to buy something that has a lot of value at 50 cents on the dollar. So I definitely encourage you to check that video out. And you can do things like change jobs to get a higher salary, or also if you want to start your own business, that might be some ways to generate cash flow. And also if real estate starts slowing down with housing sales slowing in the last several months, maybe the housing market will finally start falling apart, such that in a year or a few years, there might be some legit, really good real estate opportunities to invest. And then do some rental income that way. And so across many kinds of opportunities, sometimes having excesses will lead to a bust, and then that's where the real money can be made if you can take advantage of it. And that requires that you're ready and that you can recognize when the opportunities come your way. So with that, if you enjoyed this video or learned something, please like and subscribe. And I wish you well on your journey to being the best investor you can be and making lots of money in the future. Till next time.